Okay, Christian, just sign on the dotted line.
Wait a minute. Thought my down payment was going to be 1%. Looks like I'm getting much less than that. Hold on, let me call my loan officer. David Green.
Oh yeah, hey Christian, did you get all those mortgage docs signed?
I did. And I gotta say, I'm at the closing table here. Am I wrong? Wasn't this a 1% down Zillow loan?
Oh yeah. It is a 1% down Zillow loan. Everything should be fine. Is there a problem?
Yeah, I'm looking at it here, and I'm coming to closing with much more than 1% down. What's going on here? I feel like I'm getting bait and switched.
Oh, well, it was in the fine print that we actually could only give you 1% down on houses that are priced at a maximum of $200,000. I believe you wanted something that was more expensive and you chose to buy a house that was much higher than that. But hey, I mean, it's a free $4,000, right? Can't be mad about that.
Man, it looks like along with that choice, I also chose the wrong loan officer. I got to watch Mortgage Mondays more often.
Well, unfortunately for you, you've got no loan contingency and you need to sign. So why don't you go ahead and complete the process and you can complain about me on Yelp later.
Really appreciate your help.
Welcome to Mortgage Mondays. Today we are going to be talking about the new trending loan, Zillow's 1% down low offering. Yes, that's right. Zillow is offering a 1% down loan, or are they? We're going to be talking about what it is and what you may not be hearing about loans like this one on today's show. Christian, welcome.
Absolutely. Happy to be here. But before we get to that, David, everyone knows that the most cash flow is in short-term rentals, but you might have zero experience hosting or live in a way too expensive market to invest. The Short-Term Shop can help. With agents in over 20 top short-term rental markets, the Short-Term Shop can find a property for every budget. Plus, their free self-management training leaves you with more monthly income instead of a big bill from a property manager. Start investing in short-term rentals today. Head on over to theshorttermshop.com/BP for more info. Once again, that's theshorttermshop.com/BP, like BiggerPockets.
Okay, so tell me, 1% down doesn't sound so bad, right? 3.5% down sounded good, but this is even less than that. What is this 1% down loan talk I hear of?
Yeah, it's a good question, and it's kind of a hot topic right now. The gist of it is that it's really a 3% down loan, okay? It's a 97% loan to value, which is the minimum that conventional loans have always allowed for. 3% down is always an option. There's some asterisks, though, that don't get on the front page of the headline that will, I don't want to say invalidate a lot of people, but it will lead to probably a good number of people being underwhelmed with the program. It is not Zillow's program, okay? It is a program that is very common right now. A number of lenders have come out with it. We have it in our database as well. The reason why you may not hear about it as much is because very few people qualify. And it's not as beneficial as it sounds. Number one, you do indeed get a 2% grant from the lender. So let's make an example. If you buy a $100,000 house, technically you only need to put $1,000 down, but you need a 97% loan. So the lender is going to credit you that other $2,000 to get your loan to 97%. There's a couple things that come with that. Number one, the rate's a little bit higher. So this is the equivalent of kind of like getting lender credit on a normal rate sheet.
Let me break this down, make sure I understand it.
Go for it.
Okay, so this is one of those things where if you don't understand the fine print, it can look better than it really is. The way, and I'm going to oversimplify this, that lenders make money is they originate a loan at a certain interest rate. They then sell that loan to someone else. And theoretically, the higher the interest rate is, the more that they can sell that loan for. But they also make money in closing costs when it's originated. So in general, they originate a loan, you pay them closing costs, they make some money, then they sell that paper to somebody else, they make money then too. Then they have to go originate the loan again with somebody new. Using those same funds, they sort of recycle it. That's how we keep available credit for people so that they can go buy homes. Now, what lenders will do is they'll say, hey, if we're going to give you a better rate, we just need to collect more money up front from you because we're going to make less when we go sell the loan. Or if you want a worse rate, well, hey, we'll give you a little bit of money back because we can make the money back when we go sell the loan for more to somebody else. So when you're hearing this 1% down, if it's actually a 3% down loan, but they're crediting you 2%, they're probably charging you more in order to get that 2% credit so that it's a wash or they make a little bit of money. Is that what you're describing?
More or less. That is absolutely a factor of it. And that is one of the reasonings why this may not be as good as people think. If you put the 3% down, in a lot of situations, that's not a non-overcomable amount of money, right? It's something that a lot of people can come up with, and what we recommend. You know, it's good to have a little bit of equity in that property, right, when you start, but you're absolutely going to be paying for it with a higher interest rate, right? Or higher closing costs, right? Whatever the case may be. Two other topics that may put a little nip in the butt of the idea of this product is, number one, the area median income limit. Now, what this means is that you do not qualify for this loan product if you make more than 80% of what the median income is in your area. Now, this is broken down by county. This is a very Googleable topic. I obviously can't go through every single county in America and tell you what it is. I can tell you that if you're qualifying to buy a house right now in this market, the odds are you make more than 80% of the median income limit in your area, right? With rates being where they are and purchase prices being where they are, you need to make enough money to qualify for the loan. Now, a loan product that limits the amount of money that you can make in order to qualify for some benefit is finding a way to offer something cool, but weed a lot of people out and convert them to more profitable loan products for the lender. So the reason why we're not necessarily marketing this is because it's a very easy loan product to use for a bait and switch, which I believe is probably what Zillow is doing, right? They can get you in the system, fall in love with the 1% down, get you into contract, and then say, oh, by the way, my apologies, but you actually make too much money for this loan program. We're going to need 3% down.
So theoretically, how this could work is you hear about a 1% down loan, you apply, they say, oh, I'm so sorry, you actually make a little bit too much money in your area, which you're saying is that's about anybody who wants to buy a house right now has to make more than the median income because housing is so expensive. So they say, but don't worry, we have other loan programs that would work for somebody with your income. Let me share those. And they've got your foot in the door. You're now a lead to that company and they're trying to convert you. Is that more or less what you're saying?
Absolutely. And they've probably already pulled your credit and you've submitted an application with them. So you feel a little tied at the hip at that point, right?
Yeah.
You're less likely to shop. So overall, it's kind of, unfortunately, it's kind of a shady thing that happens in the industry. We try to prevent it internally of happening as much as physically possible. Obviously, we have to switch loan programs every now and then for qualifying, but it's never something where we're going to advertise something intending to offer something else. The last thing, so I said I have 3 points that kind of put a ding in this program. The last thing is that there is a limit to the grant that you can get. With the lenders that we offer, and I'm sure, once again, I don't work for Zillow, so their program may be slightly different, but I know every single one of the 1% down programs I've seen have limits on that grant. What I mean by that is if you're putting that 1% down, let's use a $200,000 loan amount as an example, right? You're going to put 1%, which is $2,000 down. Okay, that's 1% of your purchase price. In that situation, the lender would credit you 2%, which is $4,000 for your total down payment being your $2,000 plus therefore equaling $6,000. Okay, that's your 3% down. That is the limit. $4,000 of lender credit. So for instance, if you were to go buy a more expensive house, a $300,000, $400,000, $500,000 house, and you qualified within the area median income limits and everything else was fine-tuned and you qualified, there's still a limit to $4,000. So you cannot get more credit than that. So you may go put $1 million home in contract and thinking you're going to get 2% of it covered. That's $20,000. And in reality, you're on the hook for $16,000 of that because they cap out at a $4,000 grant. Once again, not on the front page of the product. This is in the fine print. This is if you read it closely, these are the things that you uncover. Okay, so still not very honest to say, we'll credit you 2%, right? When in reality, you're going to cap out a $200,000 loan, which in most areas in the country, $200,000 isn't getting a whole lot, right?
So they'll give you a 2% credit, but they'll only extend that up to $4,000.
Correct.
Which would limit you to a $200,000 house if you wanted to get the most of the credit. Now, I'm assuming you could buy a more expensive home, but your credit will only be $4,000, not all the rest of it. So then it doesn't become a 1% down loan. It becomes very close to a 3 or 3.5% down.
Yeah, it's like a 0.2% grant, right? So you're still putting 2.8% down, which is close enough to 3. You might as well just put 3 and get the better interest rate at that point, right?
All right, so let's recap on the cap. The first thing you mentioned here is it's not actually a 1% down loan. It's a 3% down loan that involves a credit or a grant that is making up some of the money, but it's probably going to come with a higher rate to make up for that. The second thing you mentioned is that there are income limitations where you can't make more than, you have to be at 80% of the median income for the area?
Correct.
Which means these are probably not people that are qualifying to buy homes in most markets in the country, at least. And the third thing that you mentioned was the grant is limited to $4,000, and that's in the fine print. Now, we're bringing this up because this is not actually Zillow's loan. We have loans that work exactly the same way, but Zillow is advertising it because they are trying to develop leads for their mortgage business. Is this something that brokers across the country can offer? And if someone has a local broker that they've used before or a pre-existing relationship with someone that they can go ask about the loan?
Yeah, 100% it is. This is something that if a wholesale broker is appointed with the right lenders, they absolutely have this. I know 4 or 5 lenders right off the top of my head that are currently offering this in our network. It is not a Zillow loan. It's not something you can only get from one place. It's not some super special sweetheart deal because you were searching up a property on Zillow and they fell in love with you as a client. It's just something they're trying to brand as their offering, which is fair on their behalf. That's good advertising because they have the capability of doing that, but it's a little bit dishonest. Right. Especially when you're not advising people and educating them beforehand of what the fine print is on this loan. Right. This product comes with a couple things that may not end up being as good as they say.
Now, we didn't discuss this, but I'm assuming this is for a primary residence, not for investment property. Is that right?
It is for a primary residence, correct. That's the only purchase that will allow you to put down that little.
When I saw my first advertisement about this, the comments on Instagram were full of people wanting to know more, and they all thought it was for an investment property. 1% down and I could go buy a rental property. Unfortunately, that's not the case. So in general, if you're looking to buy a primary residence and you make 80% of the median income in your area and the house is $200,000 and you're okay paying a higher interest rate and you couldn't save 3%, this could theoretically be a loan that would work for people, correct?
Correct. Absolutely. Yeah, it is a product that can be used. Just make sure you understand the fine print.
There you go. So we're not against getting 1% down on your loan. It's just we want to bring you all the information, not just the part that the marketer shows you. And I'll wrap up by saying this. As I've sort of ascended the levels of internet investing guru or educator, so to speak, and I've gotten into rooms with very wealthy people who do this for a living, I've learned the conversations move away from how do we pursue excellence in our vocation? How do we protect our clients? How do we create a streamlined process that works for everybody? And they always move into marketing. How do I sell this so that somebody would click on it or buy it or get interested in it? And then, like you said, how do I bait and switch? How do I, that little Indiana Jones move where I take off one thing while I replace it with another and I hope that nobody notices? Just be aware. That's what we're here for at BiggerPockets, is to call the BS and to show you this is how it works. It doesn't mean don't do it. Just walk into it with your eyes wide open, knowing what it is that you're walking into. So thank you for that, Christian. Appreciate you doing some research into this and coming back. I remember when you said, hey, David, this isn't a Zillow loan. We do the same thing. We just don't talk about it a lot because we don't think it's a great loan product. We think that there's better ones out there. Any last words you want to leave our audience with?
No, I couldn't have said it better myself.
All righty. Well, thank you for joining me on Mortgage Monday. If you're listening to this, let us know in the comments what you think about this. Did we save you from getting your heart broke? Were your hopes getting high when you heard all this talk? Well, hopefully we stopped that emotional spike and then crash, and we're keeping you nice and regulated so that you can get healthy educational content from people that pull no punches. If you enjoy the video, please like it, please subscribe to the channel, and please share it. And again, let us know in the comments what you thought, what you'd like to hear more about, and we will make the content that you want to hear. If you've got a minute, check out another BiggerPockets video on YouTube, and if not, we will see you on the next Mortgage Monday.